All right, so you guys wanted to talk about short-dated vol supply. A little surprised, thought you were going to want to talk about execution after the other day, but fair enough. So, this is something that I've written a bunch of threads about, but maybe we can recap, some of the key points. Right, so when you think about large structural flows in the option market, in equity, I think one of the biggest themes is that the entire world of big institutional allocators and many retail investors all are sellers of relatively short dated options. So think like 1 month range, a lot of call overwriting, a lot of cash secured put selling. For income, people, use the word income a lot. I don't think that that's a really great word to apply to option selling, but that is what it is. And a lot of the reason for this historically was that there was a long time period when option markets were pretty small, and backwards, and not a lot of people traded options, that there was a lot of risk premium empirically in selling options. Options were relatively expensive, so you tended to lose money over time significantly if you were buying options. And therefore, if you were to look at back testing like a covered calls strategy, short dated calls. So like BXM index is a benchmark index for call overwriting, just where you own the S&P and every month you sell a new at the money call option. It's not that different if you sell a 30 delta call option or whatever. And just keep rolling. And in the, say, up to about 2012, you run that back test and it looks pretty good. It looks kind of like equity-like returns, but with somewhat lower volatility and somewhat lower drawdowns, a little bit of path diversification. But then what happened was that, the pension fund consultants wrote white papers and presented them to their clients with, this data and information. They said, look, you should be, moving assets from equities into option selling, at least some significant chunk, because it's, a similar but better way to get the same exposure. And one by one, you had, giant mammoth pension funds, putting 10 or 15 or whatever percent of equity-like assets into, call overwriting or eventually cash secured put selling. And the thing about it is, derivatives markets are second order. They're not really, places that you would think of as asset allocation. They're not equity markets. They're not, commodity markets. And so when lots and lots of big investors just start all doing the same thing, it just changes the price and changes the risk premium, right? So like the long-term historical backtest becomes totally irrelevant, because no one was doing those trades before, and now sort of everybody's doing those trades, right? And so that grew and grew and grew. And if you look at that backtest after 2012, at comparing, say, a covered call strategy to equity, the covered call strategy has more very similar risk to equities, the same amount of downside, the same size drawdowns, even bigger drawdowns in many cases, but makes much less return. So, worse returns, worse risk-adjusted returns, just like absolutely a lot worse in every way. And again, the difference is that's kind of like when you run a back test and there's an in-sample period and an out-of-sample period or whatever, right? The in-sample period was one where these strategies didn't really exist in any kind of scale. And so, there appeared to be some kind of risk premium, but that came from the fact that, there weren't a lot of people doing those strategies. As soon as big size got deployed in all those strategies, the risk premium compressed and compressed and compressed, until there was very little volatility risk premium left at the front of the curve. And so what that means in terms of vol supply, right? Whenever you have, an overwhelming amount of the flow in a particular type of product or risk being the same way, it means that being on the same side of the trade as them probably doesn't make sense. That means that probably being on the opposite side of the trade from them makes sense, right? And so, if you look within the landscape of options, like one thing that tends to be quite cheap is that space of, relatively short dated, call it a month, relatively close to the money, say between 25 delta puts and 25 delta calls, the kind of the relevant range for all this, large scale institutional cash secured put selling and call overwriting. And retail investors obviously love to do this stuff too. And, you see the wheel strategy guys and all of kind of the Twitter and Instagram option influencers trying to tell you to, systematically sell options, and because it's, it just works. when it really doesn't. Risk-adjusted returns are terrible relative to just owning equities, right? But so, when you're thinking about, relatively defensive strategies, thinking about, short-dated option supply, it makes quite a lot of sense. Now, we're obviously relative value, absolute return traders. So if we were going to go buy that flow that's really depressed, the prices of short-dated options, we're probably selling something against it. We're probably being, pretty more creative. But generally, if you look over time, I think basically empirically, the volatility risk premium just doesn't exist at all anymore in short-dated options. Most of the time, you'll make a little bit of money, on average, in a noisy, choppy way, selling short-dated options, and then once every few years, 5 years, whatever the time horizon is, you'll get kind of totally wiped out and give back all your P&L, and like over time, you'll kind of be flat, right? Which you should never do a trade where you have zero expected return, but you lose a lot of money when the market goes down and stuff, right? That's kind of the exact opposite. And in fact, you should be really happy to have something in your portfolio that is zero expected return on average over time, but that tends to make a lot of money when markets are down. Like, that's a wonderful portfolio diversifier, right? And so, whether it be for, tail hedging type of purposes, defensive type of purposes, or paired with, other shorts in a relative value context. Again, under the starting point of everything in derivatives markets is what are the flows, what are people doing, where is there totally one-sided market action where there are only sellers or there are only buyers, and that like gives you your clue for where to start from a strategy perspective, right? Everything is about supply and demand in the end in these markets. Nothing is there's no concept of like a static risk premium that's just kind of like this thing given from the gods, that academics can study and do 40-year back tests on, right? That idea is complete and utter nonsense. So, anyway, happy weekend. Hope for a little bit of peace in the Middle East. We'll see what we can do. Love you all.